We won't be doing a roll call this morning. We will mark everyone's attendance. But again, I wanted to say good morning. Welcome to the conference. We are the first committee hearing, so happy to have so many of you here. I am Kentucky State Representative Rachel Roberts. I'll be chairing this meeting today, along with my vice chair, Assemblyman Jarrett Gandolfo of New York. At this time, I'd like to ask for a motion to waive the quorum requirement. So moved. Second. Perfect. All in favor, please say aye. Aye. Any opposed? Very well, thank you. Before we get started with our agenda, I'd like to note that we are continuing with the new testimony process that we introduced at our annual meeting this past November. Anyone in the audience who is not scheduled to speak on an issue can fill out a testimony slip stating who they are representing and what their position is on an issue. The testimony slips can be found on the speaker table. After completing the slip, you can submit the slip to me or whomever is staffing the committee next to me, Patrick in this case, and then it will be incorporated into the minutes after the meeting. You can feel free to submit the slip on any issue. It doesn't have to be a model law or resolution. We'll start today with an update on the NCOIL Mental Health Care Parity Model Act, a model which I am sponsoring. You can view the model in your binders on page 40 and on the website and app as well. This is a model that I am very passionate about, and the overall issue of mental health is something that I have been a champion for my whole time in office, and I appreciate everyone that has participated in the robust discussions around this issue. As many of you will know, there are currently some very comprehensive and significant federal mental health care regulations that are in the process of being finalized. In fact, earlier this month, the rules were submitted to the Office of Management and Budget and the White House for final review. It's not certain as to when the rules will be released. We keep hearing that they are imminent. But based on what we've seen from the introduction of the rules until now, they will significantly affect mental health parity policy. Accordingly, I think it's best for us to put the model on hold until we see the final rules and determine how they will impact the model. It is my sincere hope that it will make some of the model duplicative and not necessary. Assuming the rules will be released in advance of our November meeting, I'll plan to have an updated version of the model ready for discussion at that time. I will note that there is one change to the model since the last time we discussed it, and that is to the last section of the model on page 47 governing coverage of mental health wellness examinations. After several conversations with stakeholders, I have removed the 45-minute timing requirement just to make that section more workable and easier to implement if states should enact it. That came from a lot of providers who thought the 45 minutes could be far too long in some cases, far too short in other cases, and wanted that language changed to industry standards. I'll now open this up to any legislators. Does anyone have any brief questions or comments on the Mental Health Parity Act? Representative Janae from Colorado.
We'll go with Senator.
That's a new change. Senator, thank you.
I just want to say thank you so much for your continued efforts on this. I'm really excited to see how it's coming along and also very excited to hear what the federal government comes up with. So thank you for your continued efforts. I look forward to watching it continue to succeed.
Anyone else? Next on our agenda is a discussion on a resolution in support of establishing catastrophe savings accounts. You can review the resolution in your binders on page 48 and on the website and app as well. Before we get started with hearing from our speakers, I'll recognize Mississippi Senator Walter Michael, who was the first legislator to sign on as a sponsor of this resolution. Thank you very much. Now let's hear from our speakers, and let's Kirsten Trusco, co-founder of Payments as a Lifeline. We'll hold questions until everyone is finished. Kirsten, please go ahead.
Thank you, Chairman, and thank you to Kevin McKechnie, the Office of Insurance Advocacy, and the American Bankers Association team for the invitation to join you all today. He told me I have 7 minutes to share about, we're calling them disaster savings accounts, so you'll hear that again, and the fintech, financial technology that makes this type of account much easier to have, use, and manage for people than ever before, for every American who may want one. This is a speed tour through a topic. I am happy to go into greater detail on the technology, the deployment in the field, but have to be brief today. Kevin asked I introduce myself and Payments as a Lifeline. If you want to look it up, it's PAALPAY.org. My LinkedIn is up to date. It shows a background in fintech, in insurance, in payments, and a passion for serving the underbanked. In the US, we have 50 to 80 million people without access to traditional bank accounts. It's a challenge, and it's especially a challenge in disaster response. What is PAL and who belongs to it? PAL is a 501c3, a nonprofit. It's a coalition of financial and insurance technology firms, or fintech. PAL was conceived in Hurricane Katrina and born in COVID. In Katrina, I was at KPMG leading the only practice of the Big Four consultants that focused on serving the underbanked. Red Cross called. KPMG did a pro bono project just under $1 million to help convert Red Cross over to these prepaid cards to be able to get money more quickly to people. But flash forward, of the 1.8 million charities in the US, only Red Cross uses this, and they use a really old form of the technology. By COVID, little had changed in the United States in disaster funds delivery. So we stood up PAL as a nonprofit coalition to proactively reach across public and private sectors with a goal to educate and enable disaster and aid funds to be delivered fast, safe, with automatic accounting and fraud control. The American Bankers Association Office of Insurance Advocacy is part of this leadership team of PAL. PAL also has a broad advisory council comprised of innovative leaders in this space to advise, inform, and introduce PAL to their networks. These advisors span across government, the largest NGOs, corporate foundations, and even some of the smallest, most agile nonprofits. What problem is PAL trying to solve? PAL's mission is to fill a huge gap in disaster resilience, delivering money to the right person at the right time for the right purpose. PAL delivers funds, money from nonprofits or from government into the hands of survivors quickly while minimizing fraud. We explain to the funders that money is delivered fast, safe, and with dignity. How can PAL do all of that? It's using fintech and payment technology that can credential the survivors, track the payments anonymously, anonymized aggregated data, and block unauthorized use. PAL partners with Visa and other top fintechs in doing this. Has PAL been deployed to disasters? Yes. PAL has been on the ground since 2021 across the US and into Europe. We've spanned from delivering initial funds in minutes for people to get safe, all the way to the long haul 5 to 7 year plans for recovery and rebuild. We've helped in hurricanes, tornadoes, building collapses, fire, COVID, medical disasters, including Maui. Now we're part of a proof of concept in a low-income county in North Carolina to build disaster financial resilience in advance. We're partnered with the county, with the government, with nonprofits, and with FEMA. And a key goal here is to build a template so this can be repeated again and again across counties and cities and states to build in advance disaster financial resilience. PAL and its members are part of the FEMA and SBA Disaster Financial Resilience Collaborative, as is the ABA. Let's talk a bit about preparing versus responding to disasters. Let's build the ark before the flood comes. The PAL technology can do 3 things to build resilience before disaster. Help recipients to harden their homes to lessen the disaster impact and reduce insurance claim costs. It helps people to escape to safety faster. And number 3, it speeds survivors on their journey back to a normal life. Knowing PAL is there and ready to deploy is one element of a resilience strategy. A larger effort, but one that takes time to become effective, would be to have every American who wants one to open and fund a disaster savings account. This enables Americans to save now for future disruptions instead of waiting for financial disaster and rescue later. Here's a bit about the disaster savings account. After government, the financial systems know your customer regulatory process is the most powerful credentialing system that we know of. In the successful health savings account model, accounts are opened in banks using social security numbers, address, and the full universe of government-issued ID to establish that the beneficial owner of the account is who they or their employers say they are. Today, tens of millions of Americans, more than a third of all employees, have HSA funds in almost 40 million health savings accounts, which by definition is money sitting there waiting to be used for expenses associated with medical care. Contrast this to every other health benefit or insurance scenario where people start the calendar year with $0, but HSA owners have this money in savings set aside in advance. This is the world we should all want for the property casualty market. Via disaster savings accounts, Americans would be able to save for future disaster expenses on the same tax advantage basis that HSA owners now have for healthcare expenses. So disaster savings accounts as resiliency, a conclusion. Just like preventative care is a qualified HSA expense, making your home more resilient to disasters should be a DSA expense. The proposal ABA has drafted, based upon the late Senator Emhoff's 2014 bill, specifically embraces pre-event remediation as qualified expenses. The remediation via disaster savings accounts could deliver 3 key benefits. It could lower claims costs in disasters. It could potentially lower premium costs over time, maybe even attract more insurers in to specific states. Imhoff had said, "I've never seen a disaster made worse by affected individuals having more money." Adoption of the disaster savings accounts over time means that Americans will be empowered to meet the costs of being prepared before and to recover from a disaster before it strikes. I urge you to support the resolution and to support the Disaster Savings Account Coalition that the American Bankers Association is assembling. Thank you.
Thank you very much, Ms. Trusco. Next, we'll hear from Jason Lane. Jason, please introduce yourself, and then we look forward to hearing what you have to say.
Thank you. Thank you, Madam Chair. Members of the committee, I'm Jason Lane, Senior Vice President and Director of Government Relations for the California Bankers Association. The association represents the majority of banks doing business in California. We are all aware of the acute regulatory and environmental challenges that issuers have identified as stressors, especially in the California market. Before the advent of health savings accounts, health insurance struggled in a similar way. There wasn't an insurance product available to people that incentivized savings through tax advantages. Property casualty markets face the same problem today. If Americans could save tax-free for disaster preparation, we might expect to see a number of beneficial market adjustments. For example, in order to address rising premiums, homeowners could take advantage of the savings offered by higher deductibles. Higher deductibles likely benefit insurers as well. Attracting capital is already hard to find, but could be easier if exposures were reduced across personal lines. We would expect savings and reinsurance for that market as well over time. We would also expect to see Americans saving sufficiently to at least pay their deductible through their disaster savings account. Consumers with increasing funds, specifically set aside for disaster mitigation, pose a very different risk than consumers without such a savings vehicle. Americans should be able to save for their future disaster expenses on the same tax advantage basis that HSA owners have for future medical expenses. Owning and protecting where you live, even if you rent, is as vital as food security. Since disaster savings accounts would be serviced and maintained by banks, those accounts will enjoy all the fraud mitigation and safety and soundness regulation governing existing depository accounts. Just as HSAs are frequently restricted to qualified expenses through merchant and product codes, DSA funds would be subject to similar restrictions in the law and similar technology in the marketplace. The proposal that that the American Bankers Association has drafted really embraces the concept of pre-event remediation. Adoption of DSAs over time means that Americans will be better prepared to meet the cost of recovering from disaster before it strikes. I urge you to support the resolution and to support the DSA coalition ABA is assembling. Thank you.
Thank you, Mr. Lane. And next we'll hear from Kevin. Kevin, if you want to go ahead and introduce yourself and let everyone know who you are, and then we look forward to hearing what you have to say.
Yes, thank you, Madam Chair, and good morning, distinguished members of the committee, and thank you very much for introducing and considering the resolution, and thanks, therefore, to distinguished members of the committee who are sponsoring the resolution. To wrap up from our side, let me say this. You've heard about pre-funding and becoming more resilient before the storm. You've heard about the good things that happen in the health savings account example, where people prepare by definition for medical emergencies they don't know about yet. I was unaware until Kirsten invited me to her group that our predominant methodology for managing disasters in this country is to identify the survivors and wait for nonprofit companies to give them money. And that's well and good and stands, I suppose, in those organizations' good favor, but that's not a strategy. This is a strategy. This is something everyone can have access to. This is something the government can put money into if they choose to. It's something people can put money into so that they can help themselves. And it's something that your employer could put money into. And that's how health savings accounts work. And that's why we think that harnessing the engine financial services offers Americans to make them more resilient before the disaster will ultimately inure to the benefit of all of the states, which I think is everybody at this point, that's experiencing some kind of deflection in the natural course of convective storms, terrible hurricanes, earthquakes. If you're shaking, on fire, or drowning, you're going to need help, and you're going to need help quickly. That's Kirsten's job. But if you wanted to get out of the way or make your home or apartment more resilient before any of those things happen, you're going to need a disaster savings account, which is why we're very grateful that you support them, and we would encourage the states to adopt them, as our friends in Alabama, Mississippi, and South Carolina have done. Obviously, our team is here to answer any questions you might have, and thank you again for having us.
Thank you so much. As a legislator from Kentucky, and I know this is true of all of the legislators here, we've all had our states face natural disasters, and as these continue to happen, I'm very excited about this prospect to help our constituents and the people of our states. Several of us were just in D.C. for the NCOIL fly-in. We had some really great, robust, forward conversations around this on the Hill as well. So again, thank you. At this time, I'd like to open this up to any legislator questions or comments. Does anyone have any?
Thank you, Madam Chair. Larry Walker from Georgia. You compare this to health savings accounts. Health savings accounts require that you have a qualified high deductible health insurance plan.
Yes, sir.
Does your legislation propose requiring property insurance with a certain minimum level of deductible?
No, sir. Senator, it doesn't contemplate that at all. And within the...
Kevin, will you turn your microphone on?
Oh, sorry. Can you hear me now? Senator, it doesn't require an insurance mandate at all. And within the ranks of the HSA industry, I'm executive director of the ABA's Health Savings Account Council. There is an industry-wide request of Congress to retreat from that mandate because we don't think requiring insurers to alter how they do business is the right way to move forward here. What we think is that people should be saving money for themselves, and the insurance industry may start offering products that are more advantageous for both them and for their policyholders. I'll give you an example. If you have the tolerance for it, should you be able to buy a policy that has a $5,000, a $10,000, a $25,000 deductible? Sure, but I think the market can sort that out. It shouldn't be part of the legislation.
Could I follow up to that, Madam Chair? I just, I don't want to incentivize people going uninsured.
No.
And then we the public having to, bail them out just if they have $10,000 in an account. And Could I ask one more question, Madam Chair? So the way health savings accounts work, as you, I'm sure know, is you don't really have to pre-fund it. You can
No.
actually run your money through after you incur the medical expenses. Would this work the same way? And if so, that seems to kind of defeat the point to me.
Well, there'd be flexibility. It could work the way you described. It could also be because it's contemplated as an employee benefit. Your employer could fund it, and 14% of all of the contributions to HSAs in 2023 were employer contributions. Would you fund it ahead of time? That wouldn't be prohibited. And so one idea that's emerged is during the underwriting process for a new mortgage, would you want to include full funding for your catastrophe savings account, your disaster savings account? That would be an option that's open to you. But if you don't have any money to do that, or if you have yet to accumulate the dollars to do that, would you fund recovery or preparation without putting that money first in your DSA? We have the technology in place already so that any contributions can be made HSA qualified, and we would contemplate having that technology copy and pasted to the DSA side.
Thank you.
Does anyone else have any questions or comments at this time? Representative Meredith.
Thank you, Madam Chair. So my understanding is this would take change in both federal and state statutes to make the tax pieces of this work, correct?
I think so, but and I apologize, it's my deficiency. I'm a little hard of hearing. Could you restate your question, sir?
It would take statutory change at both
Yes.
the federal and state level for the tax advantages of an account like this to work. There's no way under federal mechanisms now to allow for this. It would have both change at the federal and state level.
Yes, it would have to be a bill in everyone's legislature and Congress to create the vehicle in the first place.
Thank you.
Senator Hackett.
Yeah, I just have a question, and I totally support the bill. I mean, one of the problems we've seen in the bill, you know, the only problem that I see with the bill is it has to be a catastrophe. And one of the problems that a lot of insureds are facing is a huge increase in premium rates. And so if you're in an area where you don't have a catastrophe, you can't really use this type of savings account to help you pay the premium on that. And I realize that, we don't want to create a product that high-income people can use as a tax break, et cetera. But in the same token, was there any thought about if you face such an increase in premium over a period of time? And I know there is a way you can, if the insurers are pulling, if the companies are pulling out of a state because of a catastrophe, I mean, there's ways that you can do that. But what about premium helping consumers? Because insurance companies a lot of times will increase, even though they'll have a problem in Florida, you'll see premiums somewhat increase across the country at some of the national companies. So was there ever any thought that maybe these accounts could be used to pay premiums or not without a catastrophe, without, people playing games?
Yes, sir, there is. And in the proposal, there's things you can use the money on before any kind of disaster strikes. And those things do include certain features of being able to manage your insurance costs, so the cost of the product you're purchasing. And the other way they manage insurance costs is were you to experience or be in a floodplain, you could purchase something like a new base flood elevation certificate with those dollars, and that's specifically written in the proposal. And the way that the IRS code works for HSAs is there is a list of how an HSA works, and there's an entirely separate list of what you can spend your money on. And in this proposal, that model would be the same, with one exception. There would be a list of things pre-event that you can spend your dollars on: resilient roofs, hardening, more storm-resistant windows, and limited insurance products. In HSAs, you can, for example, use those funds to pay for COBRA expenses. And so we would contemplate, if you were, oh wait, there's going to be a huge spike in Ohio, but there's nothing happening in Ohio. Well, maybe that's something that ought to be qualified. And in your legislature, you might contemplate that, and we would respect that at the federal level as well.
Thank you.
Representative Bennett.
Thank you, Madam Chairman. Sorry. We learn a new microphone system every time we have one of these meetings. Kevin, thank you for explaining all this to us. You mentioned earlier that Representative Meredith's question about federal and state changes being needed.
Yeah.
The way that I think about this is sort of like the 529 education savings plans that we have in Oklahoma that don't necessarily, as far as I'm concerned, require any federal approval. So, I mean, what's the issue of the federal piece there? Is it portability of the
Sure.
of the savings account? I mean, I see a future where we're able to kind of establish this at the state level without necessarily the federal government's.
Well, you're absolutely right. As a matter of fact, the resolution starts in that spot, which is it would be appropriate and encouraged for all of your states to do what South Carolina, Mississippi, and Alabama have already done. There are, however, a couple of states that do not have income tax. And so one of the pressures not to establish one of these things if you're a consumer is what really is the benefit to you. The emphasis on having Congress do it, just like in HSAs, is federal income taxes are the much larger bite of everybody's income. And without a tax discussion or going into that space, all we're suggesting is that government start incenting people to take care of themselves before there's an event. And the best tool you have to do that is to forgive collecting taxes on whatever you can put into the account. And that number, just to head off that question, Madam Chair, you have to pick a place to start or they can't score the bill, and I'm sure you're familiar with this in all your legislatures. Excuse me. So that number is $5,000. You can put $5,000 into your account, and that would come off your adjusted gross income, just like it would in a health savings account environment. And that number is arbitrary. You can engineer it to your heart's content. Whatever the system can bear is whatever the system can bear.
Are there any other questions or comments? Thank you again to our speakers and presenters on this issue. I think given some of the questions we had today, we will bring this back up for further conversation at our fall meeting. Thank you again.
Thank you.
Return to the beginning of the agenda for a moment. I did forget to ask for a motion to approve the April 12th meeting minutes. May I have a motion, please? Thank you. May I have a second? Thank you. All in favor of approving the minutes, please say aye. Any opposition? Thank you. Now back to our regularly scheduled program. Next up on our agenda is a discussion on the recent federal rules encroaching on the state-based system of insurance. We'll start with the tri-agency rule, which deals with several items, including short-term limited duration insurance and fixed indemnity insurance. I note that NCOIL did submit a comment letter opposing the rule, which you can view on the website and the app. The nature of the opposition from NCOIL is jurisdictional in nature, focusing on the fact that regardless of one's views on these types of products, they are best regulated at the state level under the state-based system of insurance. With us here today is JP, who probably needs no introduction to this group, of Health Benefits Institute. JP was scheduled to deliver a joint presentation with Lucy Culp of the Leukemia and Lymphoma Society that would serve as somewhat of a point-counterpoint, but unfortunately Lucy came down with COVID and could not join us today. But we're happy to have you, JP. Thanks for being here, and please go ahead.
You bet. And thank you for NCOIL for offering a costume to differentiate the comments. Chose not to take them up on that offer. Wanted to start with some background. We can go to the next slide. So short-term limited duration insurance is something that's existed for quite some time. It was used to fill gaps, obviously. For the longest time, it was set to be 12 months. States allowed extension. Individual state laws had rules. The short-term limited duration really functioned very similar to what was the individual market pre-ACA and pre-HIPAA. There was broad underwriting. In fact, usually a 5-year or a 2-year look back as a piece of that, and pre-X that was applied pretty broadly. There were always some concerns around the way those, some of the policies were underwritten as a piece of it. But it was really functioning to provide coverage for consumers who were facing a gap, right? That you're moving, I had short-term insurance decades ago when I left college in between looking for a job. Others had it during that time as well, when they're looking for those in between jobs, when you had waiting periods, those sort of things. And so that continued to be sort of the product. Next slide, please. We move forward, and short-term became a little bit different market. Now, we're going to talk about fixed indemnity in a minute, and there's a number of policies that are considered what are called accepted benefits. These are policies that are accepted from federal regulation. Short-term is not that. It's a separate sort of carve-out through the ACA as a piece of it. And increasingly, as the market deteriorated during the later Obama years, there was concern that there was cannibalization of the individual market into the short-term market. And so the Obama administration at the very end took action and moved that down to, and I'm doing this, by the way, in my Lucy voice, just FYI, this is Lucy's slide. They moved that down to a three-month time frame. Now, it was never functionally implemented. It came through. It didn't end up being implemented. The Trump administration rescinded the rules, and then, as you know, moved to the interesting definition of short-term being 1 year, and limited duration being defined as 3 years. So you essentially had a 3-year policy, which again made these short-term policies very similar to what the individual market looked like pre-ACA, with the underwriting, typically no pregnancy coverage, typically no mental health coverage attaching to it. Next slide. Now, moving on to hospital and fixed indemnity, just to explain what it is. These offer fixed payments based on various benefit triggers, $100 per day if you go into the hospital. These are not intended to provide full coverage for your medical, and will not, in fact. Think of, and I'm not going to, I probably shouldn't do this. My AFLAC folks will probably come after me later, but it's the AFLAC style policies, right? Where you get paid if you have something that happens. Under HIPAA, it is an accepted benefit. It's exclusively regulated by the states. It is required to be non-coordinated as a benefit. Initially, the Obama administration, during its time, had created rules that required you to, in fact, prove that you had major medical coverage to be allowed to purchase fixed indemnity coverage. The subject of the lawsuit, Century United v. Burwell, they lost that case. The case is interesting from the standpoint that it means that there were some pretty significant limits placed on that the Biden administration sort of jumped through and just ignored. There are states, again, are the primary regulator. We are continuing to have calls. NEAC Model 170 was adopted when I was still a regulator, so that gives you an idea of how long ago it was, how long we've been working on Model 171, which is the regulation version of that. So we've been working on that since then. That's a long time. And it's important to note that states have rate and form filing on this. They have licensure of the underlying insurer. They have requirements on the agents, and they actually deal with the consumer complaints. So they have the entire nexus of hospital indemnity from a regulatory standpoint. Next slide, please. And again, the concern from the consumer groups is that there have been policies that have moved towards looking a lot like replacing major medical. There was a company offering what you would call RBRVS rates, Medicare rates, a percentage of Medicare rates as reimbursement. That was their quote-unquote fee schedule, and offered policies up to, I believe, $1 million in coverage. That looks awful like a major medical policy, so there was some concern. In fact, that company has now shifted away from that market and is trying to sell a major medical and actually try to do ACA policies under that restriction. And again, to voice the consumer concern, not all states have taken action. There's a feeling that there are certain states that have not aggressively pursued problematic areas and have not aggressively pursued companies that are in fact marketing and developing these products as ACA replacements. And in a number of cases, there are file and use policies, so they're never actually looked at. I would note, the idea of the number of people, we'll get an idea of the number of people subscribed. The NAC has what's called a market conduct annual statement, and they are now doing their first iteration of the other health. And we really have no idea how many people are actually enrolled in these policies on a state-by-state basis, all the accepted benefits. Next slide, please. So for the final rule on short-term limited duration, now we're going to the present. We were in the past, and now we're here. The federal government, this is where the primary regulatory efforts have been inside this rule. They have now, again, limited the short-term limited duration to 3 months. They've redefined what limited means to allow a 1-month extension, so a 4-month maximum. There are new requirements on the issuer. The issuer, in fact, is not allowed to issue multiple policies, but that also applies to the quote-unquote group, and this is where we expect a lawsuit to come eventually. So if you are XYZ insurance company, XYZ holding company, and you have 12 insurers under your arm, in normal insurance parlance, each one of those 12 can issue policies. Right? So they're all separate and they're separately regulated. Under this rule, it says if any one of those 12 sells a short-term limited duration policy to a consumer, in fact, XYZ insurance company is barred from selling any more policies. It's important to note they did not, and I found this interesting, that they did not create a new special enrollment into the individual market once your short-term policy ends. So you have a 3-month policy. Once that ends, then you are subject. You don't have an SEP, so I don't know what you do. You have to buy another short-term policy if you're in the middle of the year if you don't have an SEP. Now that does not apply to the group market. If an individual is in a short-term policy and they move into a group, the SEP applies. Special enrollment period. That means that they get access to the employer coverage. The other interesting piece here is the effective date. The effective date is 9/1. Which functionally means for you as state legislators, pretty soon you may start hearing that short-term policies may not be available depending on the filing issues inside your state. It's going to be very difficult for insurers to file these new versions of these policies to be available 9/1. And given that this abuts against the ACA filing deadlines for major medical, it's almost impossible for most states to actually go through this process. So that's going to be a concern from availability, at least probably from 9/1 to 1/1 of 25. Next slide, please. The fixed indemnity rule had a number of big changes proposed. They backed off on almost all of those and actually have it's merely a new consumer notice. There is a bit of a problem, and again, another filing issue. It's effective January 1, 2025. The federal government has decided that you need to, in fact, send a new notice to every single consumer who has ever purchased a policy and has it in effect. So if you purchased your policy in 1998, you will get a new notice indicating that you have a fixed indemnity policy and what it is, and you're required in most cases to file those with the states. So there is some concern, again, from an availability standpoint and a filing standpoint, that that's going to be a problem. There is also some concern, and there's actually a lawsuit. The company that was Century United v. Burwell is now Manhattan Life. They changed their name. They are suing over the notice, arguing that this notice, in fact, did not meet the standards. And if you read the notice, it's in fact, at least from our perspective, inaccurate. It says it is not medical insurance. Fixed indemnity is medical insurance. It's just not major medical insurance, so we agree with the sense it's not ACA qualifying, but it is medical, so we have concerns with that. Next slide. And they also proposed a number of changes, and they pontificated a lot inside the rule about what they're going to do potentially next year. They were looking at a stricter per period basis to basically require you, instead of saying you can do $100 for a doctor visit, you can now only do $100 per day. That's it. And you could not have any other sort of variations in it. They also had a broad concern about the IRS tax treatment. They want to treat these as taxable policies, that if you receive a benefit, so if your car gets destroyed and you get money for a new car, you don't necessarily have to pay taxes because they're reimbursing you. Same thing here, except they're proposing that this in fact becomes taxable. They've also talked about specified disease. Now, specified disease policies are policies like cancer that provide cash in the case you're diagnosed with some horrific disease. They're concerned that, they highlighted a concern that if they implement the fixed indemnity rules as they proposed, that insurance companies will respond by creating more robust specified disease policies. And so that is their concern. They highlighted that. Last, they had a long discussion around level funded plans. Level funded plans are self-funded ERISA plans sold to small employers. Those plans typically have what you would call low attachment points. The risk to the employer is low. There's substantial reinsurance. But they're concerned that, again, in the small group market especially, that is cannibalizing the small group market and making the ACA small group market much more risky. Again, it's not something that HBI agrees with, but that is certainly what the administration and some of the consumers are concerned with. Next slide. Want to highlight a couple. We talked briefly about this. On short-term limited duration, I'm looking to have some discussions with some folks. I'm not aware of lawsuits, but of course I would not necessarily be. But I'm expecting that there will be some lawsuit related to both the timing, the 9/1, looking for a delay because it's impossible, and more importantly, the control group. I talked to one lawyer for an insurance department who believed, he gave it an 80% shot that would be knocked down, that's a problematic sort of proposal, that there's really almost nothing that applies on a group basis rather than an individual insurer basis. So that's something. And again, we talked about the fixed indemnity lawsuit potentially on the notice, Manhattan Life. We expect that is coming. I will also note we've heard the administration, if you look in their administrative guides, they're expecting to reissue these rules early next year, and as a result will likely, they feel they can go straight to final, so there'll be no opportunity to provide comment. Next slide. Our concerns, I think in general, we believe that states, again at HBI, that states are the best place to regulate this. We do think that the way they sort of structured the short-term limited duration is anti-consumer. We would have preferred, if you're going to limit the time frame, that you allow consumers to have a policy through the end of the year and align that up with the ACA open enrollment periods because there are people who will miss the open enrollment deadlines and will not be able to buy coverage. We do support, the idea that none of these products should be sold or marketed as ACA replacements. And we're also concerned, I think, on the fixed indemnity side that this is a product that has worked for years for consumers and provides support for the really high deductibles that we're seeing in the market. Next slide. And last, from the patient consumer standpoint, I think there's broad concern from the consumer groups that you see some problems in this market. Lucy highlights the secret shopper studies. If you are looking at somebody who is going to a licensed agent, you see less problems. If they're going to a call center, they have seen some problems in enrollment, aggressive tactics, folks who are not in fact licensed. There are some legitimate concerns. I would say, that from my perspective, states are trying to find that. It's harder to deal with. And there are concerns, I think, inside the market when you look at whether or not this is going to have a negative impact on the ACA market. That's sort of the focus and the reason the Obama administration is taking action. And then, short-term limited duration, again, we've talked about this, that there's a feeling that states have a hard time regulating it. I would note, and that's partly because they're sold through associations, so you buy your coverage from associations, it's from another state, and they may be licensed in, say, Missouri, but the product actually is sold out of, say, Kentucky. And so there's a concern there. Last, on fixed indemnity, I think there's some broad concerns about the policies getting a little bit more robust and not being replacements, the so-called mini-meds which existed pre-ACA. And I think that's the last slide, if I remember correctly. Yep. And happy to answer any questions. Thank you for your time.
Thank you, JP, and thank you for covering Lucy's work as well here, too. Please wish her well for us and thank her for her efforts. At this time, we'll open it up to any legislative questions or comments. Are there any? You apparently covered all the things.
Thank you.
Well, thank you very much for that. I note that NCOIL does have an existing short-term limited duration insurance model law that is scheduled to be considered for readoption next year. So it will be interesting to see how these rules will impact the model being readopted. Thank you again. Next, we'll focus on the Federal Trade Commission's non-compete rule. Again, I note that NCOIL did submit a comment letter opposing the rule, which you can view on the website and the app. And again, the nature of the opposition from NCOIL is jurisdictional in nature, focusing on the fact that the rule is an unlawful encroachment on the state-based system of insurance. With us here today are Jonathan Harris of Loyola Law School and Wes Bissett of the Big I. We'll hold questions until both are finished. Professor Harris, please go ahead, and thank you for being here.
Thank you, Madam Chair, and thank you for members of the committee for having me. I'm an associate professor of law at Loyola Law School, Los Angeles, right up the road. My research and my teaching focus on contract law and the intersections with the workplace and employment law. And I've written quite a bit about restrictions on worker mobility, including non-compete agreements over the last years. I'm going to be brief. I'm going to just cover three things here. The first is, what does the FTC's rule banning non-competes say? The second is, why did the FTC decide it was necessary to issue this rule? And third, what are the prospects for this rule going forward, as well as other possible bans on non-compete agreements and other restrictions on worker mobility? So first, what does the rule say? It's pretty simple. It bans all contracts or policies that prohibit a worker from or punish a worker for leaving a job to work for another employer or operate a business. It includes not only formal employees, but also other types of workers, including independent contractors. So it's quite expansive in that way. And it has no exceptions, except for what it calls senior executives, who are employees who earn over $150,000 a year. For those workers, existing non-compete agreements are okay, but they can't be bound by new ones. The rule also includes de facto non-compete agreements, things like training repayment agreement provisions or traps that employers impose to require workers to repay their training costs if they leave within a certain period of time. Also, non-solicitation agreements. And it says that contracts like that function as non-compete agreements by effectively keeping workers from leaving their jobs or punish workers from leaving their jobs or starting businesses, function as non-competes and are also banned as well. So second, why did the FTC decide this rule was necessary? There's been some research over the past several years that's focused more on restrictions on worker mobility generally, and especially non-compete agreements. The biggest number that stands out now, about 1 in 5 workers in the United States are bound by non-compete agreements. And while these kinds of agreements began with higher skilled, higher paid employees, they have trickled down over the years to more middle and even low wage workers. Many of you might have heard the story of Jimmy John's requiring its sandwich makers to sign non-compete agreements. And that kind of thing has gotten a lot more attention by academics and policymakers. I think it also is based on President Biden's whole of government approach that he's been focusing on the last few years, issuing executive orders to promote competition and protect U.S. workers. Of course, the name non-compete agreement is based on not competing with another company. So this rule was based on the FTC's unfair methods of competition authority. And it is using powers that it hasn't exercised since the 60s and early 1970s. So that brings me to my third point, which is what are the prospects for this rule going forward and other efforts to end restrictions on worker mobility. There was a preliminary injunction issued against the rule earlier this month in the Northern District of Texas. The judge there determined that the FTC rulemaking authority was only for housekeeping or procedural rules, not sweeping substantive rules like this one. There's another case in the Eastern District of Pennsylvania that also challenges the rule. We might end up with a circuit split, with the Fifth Circuit ruling one way and the Third Circuit ruling another. It could arrive at the doorstep of the Supreme Court, and as we've seen lately, the Supreme Court has more of a general hostility towards administrative agencies and their expertise than we've seen in the past, as well as its newly created major questions doctrine that it might use either both of those to strike this rule down. One interesting thing, though, about it is there are some people who have advocated for the rule based on the fact that it promotes a free market, according to them, and that, for those in favor of getting rid of artificial restraints in markets, including labor markets, they saw it as a good thing. There were 26,000 comments that the FTC received for this rule, and they said that 25,000 of those were in favor of it. So in the meantime, while this rule works its way through the courts, there are other agencies that are getting involved in non-competes and other restrictions on worker mobility. Remember the whole of government approach, those agencies are doing this. The NLRB, National Labor Relations Board, is one of those. The NLRB General Counsel last year issued a memorandum declaring that she believes most non-compete agreements are in violation of Section 7 of the National Labor Relations Act because they have a tendency to chill worker collective organizing. That is, if you raise the consequences of being fired for organizing a union by not only losing the workers loses their income, but also not being able to get another job, that has a tendency to chill their right to organize and act concertedly. And an administrative law judge just a few weeks ago agreed with her and ruled that non-compete agreements and non-solicitation agreement that an employer had were unlawful under the NLRA. So we'll see where that goes. As it relates to looking forward, it sounds like ALJs with the NLRB might be more protected than other in-house agency judges. So there's a more worker-friendly board in NLRB right now in place, and that would probably last through any new Trump administration, even if that comes to be, for a little bit. So that's one area. Another is the Department of Labor has been suing employers for using restrictions on worker mobility, including those training repayment agreement provisions, the traps, considering them kickbacks of wages that employees are required to pay their employers. And then last but not least, of course, states and municipalities are getting into this as well. We've seen a huge focus on non-compete agreements from states in the last few years. Of course, here in California, for a long time, we've had a ban on enforcement of non-compete agreements. That law was strengthened recently to not only refuse enforcement of non-competes, but actually ban them outright. There are 3 other states where they're fully banned. Those are Oklahoma, North Dakota, and Minnesota. And then another 33 states have restrictions on non-compete agreements. Many of those restrictions include income restrictions. Colorado and DC are 2 examples that prohibit non-competes for workers earning below a certain amount. And then they're also focused on other, what they call stay or pay contracts, that are contracts that make workers pay to leave, whether it's for training costs or any other reason. And the potential of those being used more and more as workarounds to non-compete agreements. As those non-competes get more scrutiny, employers have already been talking about other ways that they can keep workers from leaving without using non-competes that they think are more enforceable. So state attorneys generals are actually looking at that as well, and enforcing their own competition and unfair and deceptive acts and practices laws in this arena. Thank you.
Thank you, Professor Harris. Wes, we look forward to hearing from you now.
Thank you. Pat, do you have my PowerPoint by any chance? You do? Okay, fantastic. Good morning, everyone. My name is Wes Bissett. I am Senior Counsel of Government Affairs for the Independent Insurance Agents and Brokers of America, or the Big I. I'm going to talk a little bit about the FTC non-compete rule, the lens through which we looked at it, and then some related issues. I guess I'd say it's not a classic insurance regulatory issue. I think it's a fascinating case study, though, in policymaking in 2024. And I imagine there are folks in this room who really like the outcome of the rule. There are probably some who disagree with it, and there are probably some who like the outcome but maybe question the means by which it was implemented. So we'll talk all about that. Next slide, please. So just to understand how independent agents looked at this, I think it's important to understand what an independent insurance agent is. So unlike other distribution channels in the marketplace, independent agents own their own books of business. They own their own businesses. That's not always the case, obviously, with other types of distribution channels. Our members are able to place business with multiple insurance companies. They're not bound to one. And just as background, the independent agent channel, based on data last year, has placed over 62% of all P&C insurance market volume in the U.S., significantly high in the commercial lines marketplace, over 87%. And our market share is growing in the personal lines market and is over 50% now in the homeowners market. But for an agent, the core asset of their agency, their business, is intangible. So employment agreements, some cases non-competes, in other cases other forms of employment agreements, are used to oftentimes protect that intangible value. So the employment agreements are used between the agency itself and the individual agents that work and operate within that agency. And they're used to protect the investments, the customer relationships that agency has, its goodwill in the community, the confidential knowledge, just generally the overall business or the overall value of that business. Next slide, please. So when we can you go to the next slide? Thank you. So one thing I think it's also important to understand too, and there's often confusion on this point, is people don't always view or define the term non-compete agreement in the way that it's used. Sometimes they think of non-competes as all forms of employment agreements out there. They'll confuse a non-solicitation agreement or non-disclosure agreement with a non-compete. But what we're talking about here is the very narrow non-compete agreement, which bars a person from working for a competitor or starting their own business when they leave a job. So essentially telling someone that they can't work in the profession that they've chosen in the area that they wish to operate. There are other narrower forms, less obtrusive forms of employment agreements out there, including things like non-solicitation agreements and NDAs. So what we're talking about in this context are what I sometimes refer to as true non-compete agreements, and not these other form of employment agreements that are often more important to insurance agents. Next slide. So the recent history here, I guess we even go back a little bit further, historically non-compete agreements were regulated exclusively at the state level. But increasingly over time, they've been subject to scrutiny, both at the federal and state level. And this is not a particularly partisan issue. Both Democrats and Republicans looking at this with scrutiny. Professor talked about how there's been this focus on low-wage workers in particular. The Jimmy John case study. People wondering, have we lost control over non-compete agreements if we're having, minimum wage employees who are making sandwiches be compelled and coerced into signing non-compete agreements and not having them be used between people who really have leverage and negotiating power. He talked about the 3 states that since the 1800s had largely banned their use, and Minnesota joined those ranks last year. We've seen a flurry, though, of activity over the last 10 to 12 years as it relates to restrictions on the use of non-competes. There have been salary thresholds that have been established, and anyone working below that salary level, a non-compete cannot be used in connection with that person. So those levels are sometimes based on annual income, they're sometimes based on hourly income, but we've seen a flurry of activity. There's a ton of bills that were introduced, but you can see there's at least 12 states in recent years that have passed something along those lines, and that will no doubt continue. And then in January of last year, we saw the FTC propose its non-compete ban. Next slide, please. When we looked at this, we testified before the FTC on this and then submitted written comments. Our initial reaction, although we didn't belabor the point with the FTC, is that they lacked the authority to issue this rule. We sort of figured it was a waste of time to argue to the FTC, who had just spent a ton of time issuing and developing this rule, that they didn't have the authority to do so. So assuming they were likely to move forward, we focused on 3 primary issues. We focused on what the rules would be. Could non-competes be used in connection with the sale of a business? All 4 of the states that ban the use of non-competes generally do allow non-competes to be used in connection with the sale of a business. That's incredibly important. We also wanted to ensure that other forms of employment agreements would not be affected by the rule. And then lastly, we recommended the addition of an exemption for highly paid workers. Next slide, please. And then when the final rule was adopted in April, I mean, this is where the policymaking part of this does get interesting. There were 3 commissioners on a 3-2 vote who decided to implement this fairly broad and significant rule and ban the use of most non-competes. Jonathan talked about the nature of the rule itself. It does have vast and significant impacts. We're talking about 30 million workers, 20% of the workforce who have non-competes today. It applies to all types of workers. It's scheduled to take effect less than 2 months from now, September 4th. And after that date, most non-competes that are in place will be invalidated, and a business would be violating the law after that if it attempted to enforce that non-compete. For reasons I'll point out here on the next slide, the likely impact, though, on agents will be lesser due to the revisions that were made by the FTC between the initial rule and the final one. Next slide. So the biggest change they made was this had been part of the initial proposal, but the inclusion of an exemption for the sale of a business. This is critically important for independent agents and for a lot of businesses, and it really benefits sellers and buyers. This is different than the Jimmy John's hypothetical, right? If you're selling a business, this is an arm's length negotiated transaction between sophisticated parties. This isn't someone being coerced to sign a non-compete if they want to work for a job. It benefits sellers because sellers are the value of the asset that they're transferring has greater value if they can enter into a non-compete. It's good for buyers because buyers have the knowledge that if they buy an insurance agency or another business, the person they just bought it from isn't in a couple weeks going to set up shop like right down the street. So it really benefits both parties, and thankfully the FTC has created an exemption that in this limited context they don't apply. The original proposal sort of arbitrarily said that they had a 25% ownership stake that said that non-competes could still not be used with anyone that had less than that. I think there were some compelling arguments that were made, and the FTC decided to eliminate that arbitrary limitation. Next slide, please. 2 other key issues that I mentioned, the 3 earlier, the FTC did make clear that in general terms, other forms of employment agreements are not affected or prohibited by this regulation. The one sort of limitation to that is if you have a form of an employment agreement that's so restrictive that really, looks like a duck, quacks like a non-compete agreement, you can't use that. And as the professor said, it's not just, it doesn't just exclusively ban non-compete agreements, but things where there'd be financial consequence for a person after the fact, right? If there were liquidated damages that you would have to pay to take another job, those are prohibited as well. And he talked about the senior executives exemption that was added. There's an earning test and a duties test that's associated with that. It has to be someone in a policy-making position as that term is defined in the rule. Next slide, please. So what's the fate of the rule? I mean, this is the big question, right? We spent about 15 minutes talking about this. It may very well be overturned by the courts. He talked about 2 cases. I think there's a third now that's been filed. You can see there in the bullet points that follow, I think these are just things that courts will be thinking about and that just observers will be thinking about. There's no federal law anywhere that expressly bans the use of non-competes. The FTC asserts it has the authority under the 1914 FTC Act to do this. The impact of this rule is vast. We're talking about 20% of the American workforce. The FTC's authority to issue legislative or substantive rules, whatever you think of this particular one, has been questioned. There are many that argue that this type of policymaking should be left to federal and or state policymakers. In this case, there's a great argument to be made, given the historical background, it should be state legislators. And then recent Supreme Court activity doesn't favor the FTC. The Chevron doctrine has come and gone since the last significant court case looking at the FTC's authority, and we now have the major questions doctrine that doesn't bode well for the FTC. I think interesting questions for policymakers, even at the federal level, are what's the precedential impact of this rulemaking if it stands? If 3 commissioners of the FTC can get together and decide to do something that's this impactful on the American economy, how can it use that, they might use it in some good ways, they might use it in some bad ways, but what are the limits on that power? How else could it be employed if it's allowed to stand? Just, for like government nerds like me, it's kind of an interesting question to think about. Final slide, please, next one. So what I suspect will happen, if I had to look in my crystal ball, this will likely be overturned. And so what we'll probably see is the states taking on their historic role of regulating and overseeing non-compete agreements. We've seen that flurry of activity. I think if the FTC rule goes away, that's certainly likely to pick up. And I guess the two things I would leave you with at the end are employment agreements, including non-competes especially in that limited case where a business is sold, are important business management tools for independent agents. And any legislation that you might work on in your states where this issue would come up, we would hope would allow the use of non-competes at least when a business is being sold and not restrict the reasonable use of other forms of employment agreements like non-solicitation agreements. So thank you very much, Madam Chair.
Thank you, Wes, and thank you again. At this time, we'll open it up to any legislator questions or comments. We'll begin with Representative Lehman, please.
All right, thank you, ma'am. So my question goes to this, to Professor. You said they're looking beyond just these contracts and saying things like incentives that you had to pay back if you leave, et cetera. I'll use an example of a family member who is a physician, got out of college, was offered a job, urology and surgical, and they paid off $250,000 of his school debt in exchange for a time period that he had to stay at that facility. If he chose to leave, he had to pay that back. He fully agreed to that because they were paying off $250,000 of his school debt. If these get tossed out, now you have the situation if you got people coming out of school, they want that incentive of, let me get a job and have somebody else pay off my debt. How is this from an impact of just maybe the economy even, and looking at those types of individuals? How would this rule impact that, and would that not create a whole nother issue on the fact that many in the medical field are using this as a tool to get out of debt?
Yeah, well, thank you for that. My first answer would be that this rule from the FTC would not impact the scenario you're describing. That wouldn't be a non-compete agreement. And for what you're describing, it doesn't necessarily sound like it would function as one either. And so,
well, to be clear, he does have a non-compete agreement, and that's part of the agreement.
Oh, well, then that part would be, then that part of the agreement would not be enforceable. The question, well, unless he's earning more than $150,000 a year, in which case he would be considered a senior executive, and the current non-compete would be enforceable, but any new one would not. On the training piece that you mentioned, though, there are examples of that. From my research, more often than not, what I've been seeing is that training costs are used to justify keeping workers, contracts to make workers to pay in order to leave at amounts that are often unaffordable for them. One example is a PetSmart pet groomer who was earning minimum wage salary and was under a $5,000 training repayment agreement provision that she ended up violating, and they sued her for that, plus attorney's fees and court costs, and it ruined her credit score. So there are, and even research has been done, has shown that most of the time employers don't use these training contracts to actually provide useful training skills to the worker. More so they use them as workarounds to traditional non-compete agreements. And I think that's why there's concern about this kind of game of whack-a-mole starting if this rule gets struck down.
And then finally, as a law professor, do you feel like to a point Wes made of three bureaucratic positions in a regulatory body can make this decision versus a legislative body, this has a huge impact? Should it not be done legislatively?
Well, I mean, that's going to be a decision for the courts to make, I think. I'm not an administrative law expert, so I'm not going to try to opine on that. What I will say is that, it did go through the traditional notice and comment period. They look at the comments for over a year. There were 26,000 comments submitted. So to the extent that any agency can do things like this. I don't think it's limited to just the FTC in this rule. I think it's a larger question of the role of administrative agencies generally.
Thank you. Next, Senator Hackett.
Yeah, part of the question is Matt asked the question I did, and I'm a layman, so I'm not an attorney, and I've dealt with this issue many, many times, and I was on the board of a hospital, let's say, for that. Many times, the attorneys they had attorneys on retainer, so many times the big corporations said, in Ohio, we really narrowed the definition of what qualified on a non-compete, so it was really hard. But the attorneys would say, for the corporation, would say, we're on retainer, we know we're going to lose in court, we'll go ahead and lose in court on that. Because the other person, as the individual, has to go out and hire an attorney who doesn't have, and they basically say to the guy, you either pay your attorney or you pay us, pay us back and don't compete. And so has that changed? Has the DOL come into the picture? Has that changed where the actual, you can read, that the person leave on the non-compete can get their attorney fees paid by the corporation, et cetera? I know anything can be done in the courts, but that was the issue that we would hold over the heads. You could leave us, but you got to go out and hire an attorney. You got to pay the attorney, so you're going to pay either way. You're either going to not compete against us, or you're going to pay your attorney because you probably win in court.
Right. Well, I think in some ways that was part of the thinking behind this very sweeping blanket ban of non-competes that the FTC ended up enacting, because they know that, while if many non-competes ended up in court, they might not be enforceable, most workers aren't going to have the ability or the money or the wherewithal to hire an attorney and fight it after the fact. And so they made the decision to do it ahead of time instead, to try to get rid of any possible confusion and that kind of deterrent. But I do think that, notwithstanding what happens with the FTC rule, there will be continued litigation about these kinds of contracts for sure, in state courts more than anywhere. And you're right. I mean, many state courts end up striking down non-compete agreements in the end. But then again, the question always comes down to, that's only if they're challenged in the first place, and then even if they are struck down, the rest of that contract might still be enforceable.
And that's why 25,000 of the 26 said that they were for it, because they were told ahead of time that, you have a non-compete clause. If you try to break it, you'll probably win, but it'll cost you money. You're going to lose either way under that scenario.
And you asked about attorney's fees.
Yeah.
I'm actually not sure about.
I don't know either.
About that question. I do know the DOL is suing some employers for using what I was talking about before, these training repayment agreement provisions, in that case, they're obviously suing on behalf of the government, but the workers, they're doing it in their interest as well.
Okay, thank you, Chairwoman.
Representative Bennett.
Thank you, Madam Chair. I don't know if Tom's in the room, but I know that he loves a little bit of drama, and he's told me that I'm too agreeable sometimes. So Representative Lehman said something that I'd love to disagree with about this decision being made by legislators as opposed to bureaucrats. And my view is that corporate lobbyists are a lot more effective than those who are advocating for removing non-compete clauses. But if it does fall to legislators to make this decision, I'm fascinated and sad about this Jimmy John's example, because they are delicious, but that is ridiculous and sounds like the next great Scorsese movie, the Subway Jimmy John's fight. But in that scenario, if, say, you live in the Kansas City metro area and you leave a Jimmy John's on the Missouri side and go get hired on at a Subway on the Kansas side, and Jimmy John's tries to sue for non-compete, but one of those states doesn't have non-compete rules and one does, don't you think then that the legislative solution needs to come at the federal level as opposed to a state level, because this patchwork then wouldn't work? I'm just interested in Also just interested in a little bit more background about this Jimmy John's non-compete, because that's just, my God, how ridiculous.
Was that for me? Okay. I'll just briefly talk about that, and then look to hear your thoughts. So first of all, my understanding is Jimmy John's no longer uses these. So after the public scrutiny, they quickly got rid of them. But in terms of your question around the state border issue, that was actually something that our legislature here in California dealt with in recent legislation, because they were concerned about the effectiveness of the state's ban on non-compete agreements, given so much happening now with remote work and companies being located all over the place. And actually, so in addition to making non-compete agreements unlawful and banned per se, also included more restrictions that make that ban more applicable to both employers and workers that have a nexus with the state of California. But as it relates to your larger point, I think that's a real argument and a real reason for why a federal approach to this, in my opinion, makes sense. I don't know if we'll get that, but it does seem like having a unified approach is better for workers and, frankly, for businesses too, so they understand the landscape that they're operating in. And one other thing I'll say, I tease my students about this in my employment law class. Non-compete agreements are unenforceable for us attorneys, and we made it that way because we know they're bad for us in many ways. So, they're bad for our clients too, and so I think there's some real logic to that. Yeah.
So if I recall correctly, I may be wrong, and then just going back to Jimmy John said, I don't want to go too deep in the well, but I actually think that there were, maybe in Illinois, in some other states, it was deemed unenforceable by courts. I even think in some cases that administrative action was taken against that, so that I think that there was the right result there. I said in my last slide that my expectation is that where you'll see most activity will be at the state level. But I do think there's another scenario that could play out. Let's assume for a second this rule is tossed out by the courts. That could create greater incentive for Congress to act. There have been bipartisan bills that had been introduced but not moved very far in the past. I'm just very cynical about the ability of Congress to pass legislation, which is why I thought that most of the activity going forward would be at the state level. But I think for the substantive reasons you outlined, if the FTC rule is thrown out, there would perhaps be some momentum behind a federal effort in a way that we just haven't seen in the past. Remains to be seen.
Thank you. We have two other legislators with questions. These will have to be our last two as we're coming up against our timeline here. So Representative Silvers, and then after him, please, Representative Meredith will be our last.
Okay, Representative Mark Tedford from Oklahoma. I'm an insurance agency owner as well. Again, Oklahoma is one of the states where non-competes are banned. What we see a lot of agencies use are these like non-solicitation and non-piracy agreements. If you could maybe respond to how the FTC rules would affect either one of those types of agreements.
So it would not, unless something would, in case, except that there would be an agreement that called itself non-solicitation, but the words were so over the top, the text, that it actually got to the point where it started to look like a non-compete. But in general terms, with a broad brush, the FTC rule only applies to true non-compete agreements and not to other forms of employment agreements, which was significant in a good way.
Thank you, Madam Chair. Forrest, since we're being disagreeable today, I have to disagree with your assessment of Jimmy John's and their deliciousness. I don't know why anybody would like that hard bread. I'd just as soon make a sandwich at home. So this is just another reason for me to dislike them. However, my actual question is much more substantive than that. And this may be an issue that is more of an issue in the jurisdiction of Kentucky where we're at. But with relation to the TRAP agreement issue that you've talked about pretty extensively, one of the places that I have seen those used tremendously in our state is with law enforcement, Because in Kentucky, you have to go through a 20-week, 22-week training process. And a lot of the larger municipalities and counties use that because you obviously have to pass that to become a certified officer. And so they use that for folks who might be on the margins and they don't think may be able to pass those. They get hired by a smaller local government unit. They go through that process, and then that larger city or county goes out and poaches those from them. Now, what we have seen effectively most of the time is that larger agency is who is end up reimbursing the smaller agency, but they do usually have a requirement for a 2 to 3 year or a payback. Would those be affected in those situations in the same way?
Yes, no, I've seen many of these, both for law enforcement, fire departments, EMTs, with, like you said, I mean, oftentimes they can kind of pit municipalities against each other, and I think in a way that's not good. So in terms of the FTC rule and its effect, I mean, first of all, these are public employers, but what you're describing, I think, would be probably not affected for a couple reasons. First of all, if you are, tell me if I'm wrong, but I've been seeing more states pass laws that require, if a municipality is poaching a police officer or someone like that from another municipality, that that municipality, that poaching municipality, has to reimburse or repay those training costs to that.
Most of ours that I have seen at the level in Kentucky are done as an agreement between the employee and the city or county that they work for.
Right, okay.
However, generally, the poaching agency is who is doing the
Who ends
reimbursing
up
to
doing
the
it,
other
right,
agency.
yeah. Okay.
But the agreement is generally between the officer and their
So, yeah,
agency.
so I've seen those too. So the answer would be if that training repayment agreement provision functions as a non-compete in the sense that it keeps the worker from leaving to seek other employment or operate a new business, then under the rule, it could be considered an unlawful non-compete as well.
Thank you, and thank you to everyone for the robust conversation here. I appreciate everyone's participation. A couple items. First of all, if you are not planning to stay for the session directly following this, please remove your name tags from the table, legislators. And to any legislators who may be sitting in the audience, you are always welcome to come sit up at the legislator table for any committee, whether you are on that committee or not. Beyond that, is there any other business before or for the good of this committee? In that case, before we adjourn, I will note that up next is our general session in this room. There will be about a 5-minute break before that begins. Hearing no other further business, I ask for a motion to adjourn. Perfect. And is there a second? Voice vote. All in favor? Anyone opposed? Thank you again very much.